Welcome back to the Daily Crypto Deep Dive. Today, we're looking at one of the biggest Bitcoin power shifts we've seen in this cycle, because Strategy has now overtaken BlackRock's spot Bitcoin fund in total Bitcoin holdings, and this is about far more than just a leaderboard update. On the surface, it sounds simple. One company now holds more Bitcoin than BlackRock's flagship spot Bitcoin vehicle. But underneath that headline is a much bigger fight over what Bitcoin is becoming, who is shaping its future, and whether this trend is actually as bullish as it first appears. Because on one side, you have Strategy, a company built around aggressive Bitcoin conviction, and on the other side, you have BlackRock, representing the most powerful form of mainstream institutional access. So today, we're going to break down the good side of this, the bad side of it, and the analyst-style view of what this really means for Bitcoin going forward. This episode is sponsored by Kraken, one of the best places to buy and sell crypto. If you want to support the show and get started with a trusted exchange, check out our Kraken link in the description. It really helps support what we're building here at Crypto News Today. Strategy overtaking BlackRock's spot Bitcoin fund in holdings is one of those stories that sounds like a simple headline at first, but the deeper you go, the bigger it gets. On the surface, it is just a numbers story. Strategy now holds more Bitcoin than BlackRock's biggest Bitcoin investment product. But under that headline sits something much more important. This is really a story about two completely different visions for Bitcoin's future colliding in real time. One vision is bold, aggressive, leveraged, and built on conviction. The other is structured, institutional, regulated, and designed for mass adoption through traditional finance. And the fact that Strategy has moved ahead tells us something important about where this market still gets its energy from. What makes this so fascinating is that Strategy and BlackRock may both be buying Bitcoin, but they are not doing it for the same reason, and they are not doing it in the same way. BlackRock's Bitcoin fund is a vehicle. It is a wrapper. It is a bridge between Bitcoin and traditional capital. It allows advisors, pensions, institutions, and regular investors to get exposure in a familiar format without ever touching a wallet or a seed phrase. Strategy is something completely different. Strategy is not offering neat access. It is making a corporate-level bet that Bitcoin is the asset, not one asset among many. The asset. And that difference matters, because it shapes how people understand what Bitcoin is becoming. The bullish argument starts with the obvious. If a public company can buy this much Bitcoin, hold this much Bitcoin, and still attract market attention, then it reinforces the idea that Bitcoin is no longer fringe. We are well beyond the stage where serious capital sees Bitcoin as some weird internet experiment. This is balance sheet strategy now. This is capital markets now. This is corporate identity being built around digital scarcity. And for Bitcoin holders, that is a powerful signal. It says conviction is no longer limited to early adopters, libertarians, or crypto natives. It has reached the boardroom. It has reached institutions. It has reached the highest levels of capital allocation thinking. That matters because Bitcoin is a game of supply as much as it is a game of narrative. Every coin absorbed by a long-term holder is a coin less available to the market. Every large buyer who locks away supply changes the structure underneath price. This is why so many Bitcoin bulls get excited about stories like this. They do not just see a company buying coins. They see available supply tightening. They see an asset with a hard cap being steadily pulled away from weak hands and into stronger ones. If demand remains strong or even grows modestly, that kind of supply compression becomes extremely powerful over time. And that is one of the strongest arguments in favor of what Strategy is doing. It is not just buying Bitcoin. It is doing so with a level of consistency and size that changes the psychology of the market. It tells other companies that this is possible. It tells investors that serious players are still accumulating. It creates a sense that even after all the fund launches, all the regulation, all the mainstream coverage, there is still room for aggressive conviction in this asset class. In that sense, Strategy is not just buying Bitcoin. It is acting almost like a public proof of belief. It is telling the market loudly that the long-term upside case is still worth taking huge risk for. This is where the more bullish analysts would lean in and say this is exactly the kind of behavior that tends to define winners in emerging asset classes. Their view would be that when an asset is still early in its monetization process, the players willing to act with the most conviction often end up being rewarded the most. They would argue that strategy is not being reckless in their eyes. They would say it is simply recognizing Bitcoin's long-term scarcity before the rest of the market fully prices it in. To them, this is what leadership looks like. This is what aggressive conviction looks like in a world where most capital still moves too cautiously. But the bad side of this story is just as real, and this is where things start to get more complicated. Because when one company holds that much Bitcoin, the market has to start asking harder questions. At what point does concentrated ownership become a structural risk? At what point does conviction become dependency? At what point does a bullish symbol also become a fragility point? The first concern is concentration. Bitcoin is supposed to be decentralized as a network, but ownership can still become concentrated in practice. If massive chunks of supply sit in the hands of a few entities, whether that is funds, governments, exchanges, or public companies, that changes market behavior. It does not break Bitcoin itself, but it does create a more top-heavy ownership structure. And when ownership gets concentrated, the market becomes more sensitive to the behavior of those biggest holders. If one of them buys, it can push price and sentiment higher. If one of them is ever forced to sell, the effect can be brutal. That leads into the second concern, which is leverage and financing risk. Strategy's Bitcoin accumulation has not happened in some clean, risk-free vacuum. It has used capital markets, debt structures, equity issuance, and financial engineering to keep buying. Bulls will say that is smart and visionary. Bears will say it is a dangerous form of corporate overexposure. And the truth is that both sides have a point. If Bitcoin keeps rising over the long term, strategy looks brilliant. It will go down as one of the boldest treasury bets in modern market history. But if Bitcoin enters a prolonged deep drawdown again, the pressure on that structure becomes far more serious. This is where more cautious analysts start to push back. The concern is not that Bitcoin itself is broken. The concern is that tying so much of one company's identity, financial structure, and market valuation to one volatile asset can create instability. A normal company can absorb cyclical weakness in a division, a product line, or a sector. But when your brand and capital structure become deeply entangled with Bitcoin, you are no longer just exposed to price swings. You are exposed to sentiment shifts, credit risk, shareholder confidence, and the possibility that your premium to net asset value can evaporate if the market mood changes. And that premium question is important. A lot of investors do not buy strategy just because they want one-for-one Bitcoin exposure. They buy it because they believe strategy gives them amplified upside to Bitcoin. In bull markets, that works beautifully. The stock can become a kind of turbocharged Bitcoin proxy, attracting investors who want leverage without directly using leverage themselves. But the flip side is that if the market stops rewarding that premium, strategy can underperform the very asset it is built around. In other words, even if Bitcoin remains strong long-term, the market may not always value strategy in the way its strongest supporters hope. That is why this story is so much more nuanced than strategy wins and BlackRock loses. In reality, BlackRock's Bitcoin fund and strategy serve different purposes, and there is a strong argument that BlackRock's route may be healthier for Bitcoin over the long run, even if it is less exciting. BlackRock represents broad access. It represents the slow, steady normalization of Bitcoin as an allocatable asset inside traditional finance. It is easier for advisors to explain, easier for compliance teams to accept, easier for retirement accounts to hold, and easier for institutions to scale into over time. It may not have the same drama as strategy, but it may be the cleaner path to durable mainstream ownership. And this is where a more neutral analyst view becomes really important. A lot of smarter market observers would probably say that strategy is good for Bitcoin's narrative, while BlackRock is good for Bitcoin's legitimacy. Strategy creates energy. BlackRock creates acceptance. Strategy helps make Bitcoin feel like a world-changing bet. BlackRock helps make Bitcoin feel like a portfolio asset that can sit inside the existing financial system. One drives imagination, the other drives normalization. And the truth is, Bitcoin likely needs both if it wants to become a truly global macro asset. That creates the central tension in this whole story. Strategy is exciting because it represents belief. BlackRock is powerful because it represents acceptance. Strategy says Bitcoin is worth betting the company on. BlackRock says Bitcoin is worth fitting into the modern portfolio. One is revolutionary in tone. The other is evolutionary in structure. And the future of Bitcoin will probably need both. It will need the believers who create momentum, and it will need the institutions who create stability. When analysts look at this divide, that is often where their views split. The more bullish voices tend to argue that strategy's approach is exactly what makes Bitcoin special. They say safe, slow, institutional access is important, but it does not create legends and it does not reshape the market imagination. Strategy does. It makes Bitcoin feel like the central asset of a new financial era. It creates headlines that pull more attention into the market. It reinforces the idea that the biggest gains still go to those willing to act with conviction before the consensus fully arrives. The more cautious or skeptical voices see something else. They see a market that may be becoming too dependent on a handful of giant players to maintain momentum. They worry that a structure built on constant large-scale accumulation can start to look strong right up until the moment conditions change. They ask what happens if capital markets become less friendly, if investor appetite cools, or if a severe bear market returns before these structures have fully de-risked. Their argument is not necessarily anti-Bitcoin, it is anti-fragility. They are asking whether the market is mistaking scale for safety. There is also an ideological angle here that should not be ignored. Bitcoin was originally sold to many people as an escape from the traditional financial system, a decentralized asset, a bearer asset, something outside the reach of the usual gatekeepers. And yet here we are, watching one of the biggest asset managers in the world and one of the most aggressive public company treasury strategies in history compete over who owns more of it. That is not necessarily a bad thing, but it is an ironic development. Bitcoin is still decentralized at the protocol level, but ownership and access are increasingly being shaped by very familiar forces: corporate power, institutional wrappers, and capital market machinery. Some analysts would say that is simply the price of success. If Bitcoin is going to become a truly global reserve-grade asset, then of course giant firms are going to absorb large chunks of supply. Of course Wall Street is going to package it. Of course public companies are going to lever into it. That is what adoption looks like in the real world. Others would say that this changes the soul of the asset. That Bitcoin may remain technically decentralized while becoming economically captured by the same kinds of structures it was supposed to challenge. That tension is not going away, and stories like this bring it right to the surface. From a market point of view, the most important takeaway is probably this: strategy overtaking BlackRock's spot Bitcoin fund is bullish, but it is not simple. It is bullish because it shows huge conviction still exists, and because it tightens supply in a market where scarcity matters. It is bullish because it keeps the narrative alive that Bitcoin is worth building around, not just trading around. It is bullish because it tells the world that even after all the institutionalization, there is still room for someone to come in and buy with extraordinary size and belief. But it is not simple because that same concentration creates new risks. It increases dependency on giant holders, it raises leverage concerns, and it forces the market to wrestle with whether the biggest Bitcoin success stories are also becoming potential weak points. And right now, the answer seems to be this: Bitcoin's future is being shaped by both the boldest believers and the most powerful institutions. That combination could take the asset to extraordinary heights. But it also means the next phase of Bitcoin will be more complex, more politically charged, and more structurally important than anything we have seen before. If you enjoyed this deep dive, make sure you're following the show. Check out our Kraken link in the description if you want to support the channel, and as always, we'll see you at the top.